Ready to turn your money into a cash machine? This video is a combination of the best strategies I've shared for building a strong passive income stream. From making $5,000 a month with just $25 a week, to using the Dividend Snowball to grow your returns, we're covering it all. I'll also walk you through how to generate $2,700 a month in passive income from dividends. And what happens if you invest $100,000 in high-performing ETFs? Whether you're starting small or ready to dive into bigger investments, by the end of this video, you'll have all the tools you need to make your money work smarter, not harder. First, let's explore one of the best ways to generate consistent long-term wealth: ETFs. Here are the 6 best Vanguard ETFs to buy and hold forever. 6 best Vanguard ETFs to buy and hold forever. In this video, we will show you and John 6 robust Vanguard ETFs that can help you weather the storm of a downturn. These ETFs offer a path to a more secure financial future, often outperforming the market, especially during times of potential market turbulence. We'll show you ETFs that can provide both capital appreciation and dividend earning potential. In the end, we'll show you an ETF that has the potential to grow your investment to over $20 million while paying monthly dividends that far exceed the annual income of most professions. Let's get right into it. These ETFs are arranged based on their potential to grow $10,000 into the highest returns over the long term. Starting at number 6, we have Vanguard Growth ETF. Known by the ticker symbol VUG, this ETF is John's first pick of the year. With a current dividend yield of 0.6%, this might not look attractive, but for the long term, you have to consider multiple key factors. First, there's the current dividend yield, which in VUG's case is 0.59%. Next, you should consider how much this dividend has increased every year. In the case of this ETF, it has a 10-year CAGR of 3.46%. Additionally, you should look at how much its value has increased over the years, which can be determined from its past performance over the last 10 years. In the case of VUG, its share price has increased by an average of 13.56% every year over the last decade. Taking all of that into account, if John invests $10,000 in this ETF, after 1 year, it'll be valued at $11,415, which will include $59 of dividends and a total capital appreciation of $1,415 in 1 year. But the real return starts when he reinvests those dividends and lets his capital grow. The same investment in 5 years will be worth $19,433, paying an annual dividend of $119. Now, the total gain on the investment, capital appreciation, stands at $9,433. After 10 years, his investment, with reinvestment, will be valued at $37,973. In 20 years, that figure will be $147,933. And in 30 years, the investment will be worth $597,288, paying an annual dividend of $8,541, or roughly $711 per month. Now, you may question how $10,000 is turned into over $500,000, but it's not only the initial $10,000 investment. Remember, John also reinvested his dividends for 30 years, which in the case of this ETF, if you add them all up, amounts to $53,391 of reinvested dividends and the initial $10,000 investment. These two figures then combine and grow to over $500,000 in total value. This ETF has been around for nearly 20 years and manages over $88 billion in assets under management. It's designed to invest in big American companies that are expected to grow a lot. What's interesting is that it tries to avoid buying all the stocks at once to prevent prices from jumping around. It also has a super low fee of 0.04%, and you can easily buy and sell it because of the high demand and supply. It has a lot of its money in tech companies, and the top two holdings are Apple and Microsoft, which together make up a big part of the ETF. VUG is a good choice if you believe in the growth of big American companies, especially in tech. Next on the list is Vanguard Mega Cap Growth ETF. Known by the ticker symbol MGK, this ETF currently offers a dividend yield of 0.52% with a 10-year annual dividend growth rate of 2.07%. However, this ETF has enjoyed an average annual return of 14.41% every year for the last 10 years, so it's safe to say this ETF primarily focuses on capital appreciation rather than generating income. Based on these parameters, if John invests $10,000 in this ETF, after 5 years, his initial investment will be valued at $20,080, or $10,080 in capital appreciation. In 10 years, the same investment will be valued at $40,431. Fast forward to 20 years, the investment with reinvested dividends and capital appreciation will grow to $165,385. In 30 years, that value will be at $686,189 and pay an annual dividend of $5,740. The dividend isn't much, but as we said, the fund is more focused on capital appreciation rather than dividends. So, how does this ETF work? MGK employs a straightforward yet effective strategy of investing in the largest growth stocks in the market. These mega-cap companies have already proven exceptionally strong and have maintained their leadership positions for an extended period. The ETF aims to track the performance of the CRSP US Mega Cap Growth Index, providing investors with a convenient way to diversify their exposure to these top-tier growth stocks. MGK's portfolio consists of 98 holdings, with the top 10 holdings accounting for 60.9% of the fund's assets. Notably, Apple and Microsoft lead the way, making up a significant portion of the fund. While technology stocks dominate the portfolio, it also includes holdings in other industries, such as pharmaceuticals and payment networks. Next, at number 4, we have Vanguard Russell 1000 Growth ETF. Known by the ticker symbol VONG, this ETF has a current dividend yield of 0.76%, which grows with a decent 10-year CAGR of 5.67%. This ETF, like most, prioritizes long-term growth through stock appreciation, which can be seen from its consistent annual stock appreciation rate of 14.37%. Based on this, if John invests $10,000 in this ETF, after 5 years, his investment will be valued at $20,343. That's doubling the initial investment in just 5 years. And it gets better from here. In the 10-year mark, John's reinvested investment, backed by dividend rate, dividend growth rate, and average annual returns, will grow to $41,918. In 20 years, it'll be positioned to reach $187,911. And after 30 years, the total value is forecasted to grow to $945,695, paying an annual dividend of $32,286, or roughly $2,690 each month. To transform a $10,000 initial investment into an investment valued at $945,695, John relied on reinvesting $165,261 of dividends in the ETF. Over 30 years, the initial investment and the reinvestment dividend combined to grow an annual average return of 14.37% to reach $945,695. VONG is known for being inexpensive to own, costing just 0.08% in fees. It has a history of performing well, often outperforming the S&P 500 index. This is because VONG mainly invests in growth stocks, which tend to do well when the stock market is doing well. VONG owns a mix of 443 different stocks, and they're the kinds of stocks that have been growing their earnings by an average of 23% every year. The biggest chunk of the ETF's money is in tech companies, especially Apple and Microsoft. This year, too, the ETF has been doing really well, going up by 26%. This might be surprising because people thought that these types of stocks might not do so well when interest rates are going up. But they've been doing great, partly because people are willing to pay more for them. And the best thing? The ETF has a good read of the market again. Next, at number 3, we have Vanguard Mega Cap ETF. Known by the ticker symbol MGC, this ETF is one of John's favorite picks of the year. With a current dividend yield of 1.45%, this might not look attractive, but for the long term, this ETF grows dividends at a 10-year CAGR rate of 6.43%. And it's also backed by a solid average year yield of 12.26%. Taking all of that into account, if John invests $10,000 in this ETF, after 1 year, it'll be valued at $11,372, which will include $145 of dividends and $1,227 of capital appreciation. But the real return starts when he reinvests those dividends and lets his capital grow. The same investment in 5 years will be worth $19,256, paying an annual dividend of $337. Now, the total gain on the investment, capital appreciation, stands at $9,256. After 10 years, his investment with reinvestment will be valued at $38,177. In 20 years, that figure will be $170,935. And in 30 years, the investment will be worth $1,027,685, paying an annual dividend of $82,460, or roughly $6,872 per month. This is our first pick, which has the potential to turn $10,000 into over $1 million. And you may question how this is even possible, but remember, it's not just the initial $10,000 investment. John also reinvested his dividends for 30 years, which, if you add them all up, amounts to $381,202 of reinvested dividends, along with the initial $10,000 investment. These two figures then combine and grow to over $1 million in total value, which pays $82,460 in annual dividends. Now the question is, what is this ETF's strategy? MGC focuses on large companies in the U.S. These are businesses worth more than $10 billion, and they tend to be steady and not too risky. The ETF mostly invests in information technology companies like Apple and Microsoft. That's about 28% of the pie. Healthcare and financials are also in there. In total, the top 10 companies make up almost 30% of what MGC holds. Vanguard Mega Cap ETF carries a Zacks ETF rank of 3, Hold, which is based on expected asset class return, expense ratio, and momentum, among other factors. Though this is our first ETF to carry $10,000 to over $1 million, there are even more potent ETFs to come. In the end, there's an ETF that can make your valuation over $20 million. So back to our list. At number 2, we have Vanguard S&P 500 Growth ETF. Known by the ticker symbol VOOG, this ETF has a moderate current dividend yield of 1.08%, which increases by 7.83% every year, also known as CAGR. Most importantly, for the long term, this ETF is more focused on growth through stock appreciation, evident from its average annual stock appreciation of 13.32%. If John invests $10,000 in this stock, in 5 years, his investment will be worth $19,823, with an annual dividend of $273 and capital appreciation to that point of $9,823. After 10 years, John's reinvested investment will be worth $40,410. In 20 years, it'll reach $192,667, and in 30 years, the total value will grow to $1,301,686. paying an annual dividend of $113,776 or approximately $9,481 per month. With this ETF, to turn a $10,000 investment into over $1.3 million in value, John had $479,913 of dividends reinvested into the ETF, which compounded over 30 years to over $1.3 million at an annual average return rate. So what is this ETF strategy? This ETF is designed to give you a piece of the S&P 500 index, which includes 500 of the biggest companies in the U.S. stock market. But what makes VOOG special is that it mainly looks for companies that are expected to grow a lot, especially in the technology sector. Hence the reason 31% of the ETF's investments are in tech companies. Tech stocks in particular have been doing great because they're expected to make a lot of money in the future. Apart from tech, VOOG also invests in consumer and communication companies that have been doing better than the overall stock market. To top it off, this ETF has low expenses with an expense ratio of 0.1%, and it's traded a lot in the stock market, which means it's easy to buy and sell. Last, at number 1, we have Vanguard Information Technology ETF. Known by the ticker symbol MGK, this ETF is a compelling investment option for those looking to gain exposure to the technology sector. In fact, as of the year-to-date YTD performance, it has delivered a strong return of around 34.18%. Before showing you what John can earn from this ETF, let's see why this ETF makes it to the top of John's list. VGT's strategy revolves around tracking the MSCI US Investable Market Information Technology 2550 Index. This means it includes a wide range of U.S. technology companies, irrespective of their size, following the global investment classification standards. The fund has a solid track record dating back more than 22 years and manages over $57 billion in assets, a testament to its stability and credibility. In terms of historical performance, VGT has consistently ranked well compared to its peers over various timeframes. For instance, over a 10-year period, it has delivered an average annual gain of 19.17%, outperforming popular alternatives like XLK, SCHG, and QQQ. This consistency can be attributed to its strong historical returns, with rankings among the top performers in its category. So, how much can John earn from this ETF? This ETF has a current dividend yield of only 0.75%, but don't get fooled by this low yield. It offers an exceptionally high dividend growth rate when compared to other ETFs. In fact, it offers a 10-year CAGR of 14.41%. And most importantly, the fund share has been growing on average by 19.17% every year. Based on this, if John puts $10,000 into this investment, after 5 years it'll be worth $25,171. He'll also receive an annual dividend of $307. All in all, he'll have a capital appreciation of $15,171. Give it 5 more years, and in 10 years, thanks to both higher dividend growth and annual yield, the number starts doubling every 5 years. In 10 years, his reinvested investment will grow to $66,308. In 20 years, it's expected to reach $645,405, and after 30 years, the total value will soar to $23,943,915, paying him an annual dividend of $6,516,715, which translates to roughly $543,059 each month. Transforming a $10,000 investment to over $23 million might sound very unrealistic, but the calculation is completely sound. The thing to remember here is that the original $10,000 isn't solely at work. The reinvested dividends that have been growing at 14.41% each year, backed by the massive 19.17% annual appreciation rate, truly accelerate the investment's growth. This means with his initial investment of $10,000, he has reinvested all of his dividends from each, which if you add them all up, is valued at $15,597,106 in dividends reinvested. These two worked together to get him to his valuation of $23,943,915. Next up, let's look at how you can rapidly accelerate your dividend income to $5,000 with a strategy known as the Dividend Snowball. The Dividend Snowball, the fast approach to living off dividends to $5,000 per month. Ever seen a tiny snowball rolling down a hill? What happens? It gathers more snow, right? And before you know it, it's turned into this massive, unstoppable force of nature. Big names in investing, like Warren Buffett, use something called Dividend Snowball. But instead of snow, this ball is made up of dividend payments from different stocks in your investment portfolio. As it rolls down the hill of time, it gathers more dividends, compounding its growth exponentially. So how does this whole thing work? And more importantly, how can it help you earn $5,000 in monthly income? In this video, I'll show you two strategies, a one-time investment and a monthly investment of $200 to reach a $5,000 per month goal. In the end, I'll show you a portfolio of stocks that has the potential to triple that return over the long run. So what exactly is the dividend snowball effect? Well, it's simpler than you might think. When a company pays out dividends, you use that money to buy more shares of the stock. These additional shares mean you'll get even bigger dividend payments next time around. This compounding effect causes your investment to grow exponentially over time, much like a snowball growing as it rolls downhill. In other words, the growth isn't linear, it's exponential, meaning it accelerates over time. The key is patience and reinvestment. Set up your investments with dividend-paying companies, then sit back and let your dividends grow and compound your portfolio over time. Just like a snowball gains size and momentum, your investments will grow too. But truthfully, understanding the concept is one thing, actually putting it into practice is another. So let's get into some real strategies that you can use to set your dividend snowball rolling. The first step starts with setting a goal of monthly dividends. And everyone's investment journey is unique. Some people want to make $1,000 a month, while others may want to earn $5,000 per month. When planning how to invest or diversify your portfolio, it's important to consider your individual financial situation and what makes the most sense for you. For this video, John will explore two strategies to determine if they can help him make $5,000 or more a month after retirement. Setting a goal gives you a target to work towards. It also allows you to measure your progress and adjust your strategies as needed. The key here is to be realistic about your timeline and the amount you can invest. Now that we have a goal, we need to determine what kind of return in stocks we should be looking for to reach that goal. Which brings us to the next chapter, my two strategies to reach the $5,000 goal. To reach the goal of $5,000 per month after retirement, you need to strategically select stocks that offer a combination of high dividend yield, consistent dividend growth, and solid share price appreciation. These three elements work together to maximize the compounding effect of your investments. Let's get to know the two strategies that can help you achieve this. Strategy 1, John makes a one-time investment of $10,000. Obviously, this strategy demands that one-time investment of $10,000. John has to put it into a stock that meets the following criteria: a current dividend yield of 8%, a dividend growth rate of 7%, and an annual share price appreciation of 6%. Over time, these factors will work together to grow John's investment and his dividend income. Here's how it plays out. After 1 year, his $10,000 investment would grow to $11,400. After 10 years, it would be worth $38,292. After 20 years, it would grow to $158,245. By the end of 30 years, John's initial $10,000 would have reached $710,970. The dividends alone after 30 years would amount to $65,055 annually, which breaks down to about $5,421 per month, meeting our goal. Now let's consider a different approach. Instead of a one-time investment, John decides to invest $200 every month into a similar high-yield, high-growth stock. This strategy leverages the power of regular contributions and compounding dividends over time. With this method, John's consistent monthly investments would look like this. After 1 year, John's invested $2,400. After 10 years, John's investment grows to $47,548. After 20 years, it reaches $246,150. By the end of 30 years, John's total investment would be worth $1,158,011. The annual dividends after 30 years would be $105,740, which translates to about $8,812 per month. Impressive, right? Now remember, at the end, I'll show you how to earn double or triple that amount in dividends with a portfolio of stocks. So we can clearly see that the second strategy has a better output than the first. The reason is that this strategy benefits from the steady, consistent growth of your investments and takes advantage of market fluctuations by spreading your investments over time. It's a great option for those who might not have a large sum to invest initially but can commit to regular contributions. However, there's one big problem here. Finding a single stock that consistently pays over 8% in dividends each year can be challenging. In fact, I don't even recommend stocks that pay dividends above 7%. That's because of the dividend trap. Many new stocks tend to attract investors with significantly high starting dividend yields, and these kinds of companies, in the end, tend to fail, and investors end up losing money rather than gaining it. To address this, I have a solution. Like I said in the beginning, to reach a goal of $5,000, you need a good mix of dividend yield, dividend growth, and share price appreciation. Here's how you do it. In the coming chapter, I'll show you how to create a diversified portfolio that balances high-yield stocks with growth potential, ensuring stability and maximizing returns. So let's talk about making a portfolio. To achieve the goal of earning $5,000 a month in dividend income, it's crucial to create a diversified portfolio that includes different types of high-yield investments. This ensures stability, growth, and consistent income. Let's make an ideal portfolio by focusing on 3 tiers of investments: dividend aristocrats or kings, strong and stable dividend ETFs, and dividend-paying REITs. In the end, I'll show you whether this powerhouse of a portfolio can earn you more than $5,000 in dividends per month or not. Back to making the portfolio. First, let's start with dividend aristocrats or dividend kings. These are companies that have a long history of consistently increasing their dividends. They've been raising the money they pay to investors for at least 25 or 50 years. Based on my research, here are some of the best dividend aristocrats or kings. The first one is Cintas Corporation. It has a current dividend yield of 0.78%, but what really stands out is its impressive dividend growth rate of 21.5% and a 10-year average share price appreciation of 27.07%. Other strong candidates are Abbott Laboratories and Bank of America. Here are the key metrics for each stock. So when we average out the metrics for these stocks, we get a current dividend yield of 1.78%, a dividend growth rate of 23.44%, and a 10-year average share price appreciation of 15.67%. These metrics provide a strong foundation of growth and income stability for your portfolio. Next, let's add strong and stable dividend ETFs to our portfolio. These funds allow you to invest in a basket of high-yielding stocks, offering diversification and ease of management. Some of the solid options in dividend ETFs include the Vanguard Information Technology Index Fund ETF shares, Schwab U.S. Dividend Equity ETF, and the Vanguard Mid-Cap Index Fund ETF shares. By averaging the metrics for these high dividend ETFs, we get a current dividend yield of 1.87%, a dividend growth rate of 12.58%, and a 10-year average share price appreciation of 11.54%. Finally, let's include dividend-paying REITs. Real estate investment trusts are required to distribute at least 90% of their income as dividends, making them a fantastic source of high dividend yields. American Tower Corporation is a prime example, offering a current dividend yield of 3.34%, a dividend growth rate of 18.83%, and a 10-year average share price appreciation of 8.16%. And then there's also CubeSmart and Rexford Industrial Realty. Averaging the metrics for these dividend-paying REITs gives us a current dividend yield of 3.91%, a dividend growth rate of 16.99%, and a 10-year average share price appreciation of 9.81%. These REITs add a significant high-yield component to our portfolio, enhancing both income and growth potential. Now, if you're wondering where I get all that data, let me tell you about our channel's official partner, Seeking Alpha. It's been my go-to tool for winning in investments. It's easy and simple, and I love how I can access under-the-radar investing ideas, earnings call transcripts, and breaking news. Plus, the exclusive data-based stock ratings have been a game-changer. Stocks rated strong buy and their alpha picks have beaten the S&P 500 by over 80%, so definitely check them out in the description, seeing as they've also promised to give a 20% discount on premium membership with a 7-day free trial at a 10% discount on alpha picks to those in our community who join using the link from the video description. Okay, back to portfolio returns. Combining the metrics of all the tiers, our portfolio averages out to a current dividend yield of 2.52%, a dividend growth rate of 17.67%, and a 10-year average share price appreciation of 12.34%. This balanced mix of stocks, ETFs, and REITs ensures that our portfolio is well diversified and poised for both income generation and capital appreciation. Now that we've established a diversified portfolio, let's get into the detailed projections to see how our investments can grow over time. I'll show you both the one-time investment strategy and the monthly contribution strategy, then determine which one is the best approach to go for. First, let's start with strategy number 1, the one-time investment strategy. Based on a current dividend yield of 2.52%, a dividend growth rate of 17.67%, and a 10-year average share price appreciation of 12.34%, if John invests $10,000 in this portfolio, after 1 year, the investment would grow to approximately $11,486. After 10 years, his investment would be worth about $42,456. At the 20-year mark, John's investment would grow to roughly $217,450. By the end of 30 years, John's initial $10,000 would have ballooned to an impressive $1,514,523, paying around $139,020 in annual dividends. This translates to a monthly dividend income of approximately $11,585. The total value added to John's investment over 30 years would be $1,504,523, with $867,217 coming from capital appreciation and $637,305 from reinvested dividends. This projection highlights the extraordinary growth potential of a well-diversified portfolio. But can strategy 2 beat these numbers? Let's find out. In this scenario, John invests $200 every month into the same diversified portfolio. After the first year, John's total investment would be $2,400. After 10 years, it would grow to about $50,687. After 20 years, John's monthly contributions would accumulate to approximately $316,483. By the end of 30 years, his total investment of $72,000 would grow to a staggering $2,273,335.
At this point, the annual dividend income would be around $208,452, providing a significant monthly income of about $17,371. The total value added to John's investment would be $2,201,335, with $1,261,355 from capital appreciation and $939,980 from reinvested dividends.
Now, you can make the dividend snowball work even faster if you have high dividend REITs that'll help you with faster initial growth. Here are the 6 best REITs to buy and hold forever. 6 best REITs to buy and hold forever. Investing can feel like a roller coaster with ups, downs, and unexpected twists. But what if I told you there's a way to add some stability to your portfolio without sacrificing growth? The answer is real estate, and you don't need millions to invest. That's where REITs, real estate investment trusts, come in. In this video, I'll be showing you and John 6 REITs that are built for the long haul. I'll explain why these are the best REITs to invest in and how much you can earn from each with a $10,000 investment over 10, 20, and 30 years. In the end, I'll show you a REIT that has the potential to turn a $10,000 investment into over $1.5 million and pay over $14,000 per month in dividends. But first, what are REITs? All right, before we jump into the specifics of our top 6 picks, let's take a moment to break down what exactly a REIT is and why these investment vehicles might be the perfect fit for your portfolio. A real estate investment trust, or REIT, is a company that owns, operates, or finances income-generating real estate. This can include anything from shopping malls and office buildings to apartments and hospitals. The best part? You can invest in these large-scale properties without having to manage them yourself. REITs pool capital from many investors to purchase and manage these properties. By law, they must distribute at least 90% of their taxable income as dividends to shareholders. This means you get a steady stream of income without lifting a finger. REITs offer an easy way to diversify your investments, as you're spreading your money across a range of properties rather than betting on a single one. Plus, they're accessible. You can buy and sell REITs just like stocks. Now that you've got the basics, next up are 6 REITs ranked from good to absolute best REITs based on their potential to add value to your portfolio. Let's kick things off with Agree Realty Corporation, ticker symbol ADC. If you're looking for a reliable long-term investment in the real estate sector, this one should be on your radar. Agree Realty is a well-established REIT that focuses on owning and developing properties net leased to major retail tenants. What's great about ADC is its focus on quality over quantity. They target high-credit tenants like Walmart, Best Buy, and Dollar General, which means the risk of default is relatively low. This focus on top-tier clients is a key factor that sets ADC apart from many other REITs on the market, providing an added layer of security for your investment. They currently offer a dividend yield of 4.12%, backed by a consistent dividend growth rate of 5.86%. Combine that with an average share price appreciation of 9.46%, and you've got a recipe for long-term success. But what does this mean for your investment? Let's say John starts with $10,000. After 1 year, his investment could be worth $11,358. Fast forward 10 years, and that same investment could grow to $33,862. After 20 years, you're looking at $104,182. And if you're in it for the long haul, after 30 years, your investment has the potential to reach $299,762, paying around $3,846 in annual dividends. When you add up the total capital appreciation and dividend reinvestment, the total value added to your investment would be around $289,762. So why should you consider Agree Realty for your portfolio? It's simple. Of course, no investment is without its risks. The real estate market can be volatile, and economic downturns can impact even the most stable tenants. But with ADC's strong portfolio and focus on essential retail,
It's well positioned to weather most economic storms. Just remember to keep an eye on the market and adjust your investment strategy as needed. Next up at number 5 on the list is Essential Properties Realty Trust, ticker symbol EPRT. This REIT is a newer player in the market, but don't let that fool you. It's quickly become a standout option for long-term investors. EPRT focuses on single-tenant, net-leased commercial properties, which means they lease out properties to individual tenants, and those tenants are responsible for most of the property's operating expenses. This setup is great for minimizing risk while ensuring a steady income stream. One of the things that makes EPRT match the REITs is its growth potential. Currently, EPRT offers a dividend yield of 3.67%, backed by a dividend growth rate of 5.7%. Additionally, EPRT's average share price appreciation of 15.18% is one of the highest among its class, making it a solid choice for investors looking for both income and capital growth. Now, let's break down what this could mean for your investment. If you invest $10,000 in EPRT today, after 1 year, that investment could be worth $11,885. Fast forward 10 years and your investment could grow to $50,674. After 20 years, you're looking at a significant increase to $225,122. And if you hold on for 30 years, your investment could soar to $952,199 and pay $1,686 in annual dividends. When you factor in the total capital appreciation and dividend reinvestment, the total value added to your investment would be an impressive $942,199. These returns sound good, but there are even better options to come. In the end, I'll show you a REIT that has the potential to turn a $10,000 investment into over $1.5 million and pay over $14,000 per month in dividends. Back to EPRT. Why should you consider Essential Properties Realty Trust for your portfolio? First, its focus on single-tenant net-leased properties reduces operational risk, making it a safer bet in the often volatile real estate market. Second, its strong dividend growth rate combined with high share price appreciation offers the best of both worlds, income and growth. This makes EPRT particularly attractive for investors who are patient and looking to maximize their returns over the long term. Moving on to our 4th REIT, which is Rexford Industrial Realty, ticker symbol REXR. This REIT specializes in industrial properties, particularly in Southern California, one of the most supply-constrained industrial real estate markets in the United States. REXR focuses on high-demand infill industrial properties, which are critical for businesses that need proximity to large consumer bases, making it a highly strategic investment. One of the standout features of REXR is its strong growth metrics. Currently, it offers a dividend yield of 3.21%. While that may not seem extraordinary at first glance, it's important to look deeper. REXR has a dividend growth rate of 13.49%, which is incredibly robust. Combine this with an average share price appreciation of 13.56%, and you're looking at a REIT that can deliver both income and capital gains. So let's break this down with some numbers. If you were to invest $10,000 in REXR today, after 1 year, your investment could be worth $11,677. After 10 years, that investment could grow to $47,091. Fast forward 20 years and your investment could be worth an impressive $221,332. And if you're patient enough to hold for 30 years, you're looking at a potential value of $1,038,308. After 30 years, your dividends could total approximately $27,985 annually, translating to a monthly income of around $2,332. When you add the total capital appreciation and dividend reinvestment, the total value added to your investment would be a remarkable $1,028,308. Now we move on to the top 3 stocks to buy and hold forever. At number 3, we have American Tower Corporation, ticker symbol AMT. Unlike the previous REITs, which focus on retail and industrial properties, AMT is a leader in the infrastructure REIT space, specifically in telecommunications. American Tower owns and operates wireless and broadcast communication towers, a critical component of the global digital infrastructure. With the world increasingly relying on wireless communication, AMT is in a prime position to benefit from this ongoing trend. The expansion of 5G networks further amplifies AMT's growth prospects as more towers and infrastructure are needed to support this next generation of mobile connectivity. It currently offers a dividend yield of 2.85%, which may seem modest compared to other REITs. However, where AMT truly excels is in its dividend growth rate of 15.22%. Additionally, AMT has an average share price appreciation of 8.66%, making it a solid choice for investors looking for both income and growth. So let's look at the potential returns. If you were to invest $10,000 in AMT today, after 1 year your investment could be worth $11,151. Fast forward 10 years and your investment could grow to $32,515. After 20 years, the value could rise to $142,614. And after 30 years, your investment might reach an incredible $1,074,517. What about those dividends? After 30 years, your dividends could total around $152,644 annually, giving you a monthly income of about $12,720. This shows AMT is a REIT that can provide both stability and significant long-term gains. It's an investment you can hold on to with confidence as the demand for wireless communication continues to expand globally. Now remember, in the end, I'll show you a REIT that has the potential to turn a $10,000 investment into over $1.5 million and pay over $14,000 per month in dividends. Next on our list is Extra Storage Space, ticker symbol EXR. This REIT focuses on self-storage properties, a sector that's shown remarkable resilience and growth over the years. As people accumulate more belongings and businesses require additional storage solutions, the demand for self-storage continues to rise. EXR has positioned itself as a leader in this space, owning and operating a massive network of storage facilities across the United States. One of the key attractions of EXR is its strong financial performance. Currently, EXR offers a dividend yield of 3.64%, which is competitive within the REIT space. However, what truly sets EXR apart is its impressive dividend growth rate of 14.52%. In addition, EXR boasts an average share price appreciation of 12.97%, making it an excellent choice for investors seeking both income and capital growth. So let's dive into the numbers. If you were to invest $10,000 in EXR today, after 1 year your investment could be worth $11,661. Fast forward 10 years and your investment could grow to $47,555. After 20 years, that amount could balloon to $239,032. And if you hold on for 30 years, your investment could potentially reach $1,281,149. But that's not all. After 30 years, your dividends could total around $61,394 annually, translating to a monthly income of about $5,116. When you combine the total capital appreciation and dividend reinvestment, the total value added to your investment would be an astounding $1,271,149. This shows the power of compound growth and the benefits of reinvesting dividends over a long period. Adding EXR to your portfolio is a no-brainer. First, the self-storage sector has proven to be remarkably resilient, even during economic downturns. People continue to need storage space regardless of economic conditions, which provides a steady revenue stream for EXR. Second, the combination of solid dividend yield with robust dividend growth makes EXR an attractive choice for income-focused investors who also want to see their investments grow over time. Finally, at number 1 and topping the list is CubeSmart, ticker symbol CUBE. Another major player in the self-storage sector. Like Extra Space Storage, CubeSmart focuses on owning and managing self-storage facilities across the United States. With the increasing need for storage solutions driven by both residential and commercial demand, CubeSmart has carved out a significant presence in the market, making it a solid choice for long-term investors. CubeSmart currently offers a dividend yield of 3.96%, which is attractive compared to many other REITs. However, what makes Cube particularly appealing is its robust dividend growth rate of 14.98%. This growth rate suggests that investors can expect their dividend income to increase substantially over time. Additionally, CubeSmart has shown an average share price appreciation of 10.64%, which when combined with its strong dividend growth offers a compelling case for both income-focused and growth-oriented investors. Let's break down the potential returns. If you invest $10,000 in CubeSmart today, after 1 year your investment could be worth $11,460. After 10 years, this could grow to $42,134. Fast forward 20 years and your investment might be worth $220,963. And if you hold on for 30 years, that same investment could reach an impressive $1,604,740. In terms of dividends, after 30 years, your annual dividend income could total around $175,387, giving you a monthly income of approximately $14,616. The total value added to your portfolio will be $1,594,740, with $774,016 coming from capital appreciation and $820,724 from dividend reinvestment.
Looking for weekly cash flow? Here are 12 dividend stocks that pay dividends every week, arranged in a way that you'll receive payments starting from the very first week. 12 dividend stocks for cash flow every week. Tired of waiting months for investment returns? Today I'm going to show you how to set up a portfolio for weekly cash flow. Yes, every week. We have a special selection of dividend stocks that keep cash coming in consistently, helping you cover expenses more predictably. Why wait for quarterly payouts when you can get paid weekly? I'll break down a portfolio of high dividend stocks, each paying out at different times, ensuring at least one payout every week. I'll explain why each stock is a solid pick and how they fit together to create reliable weekly cash flow. In the end, I'll show you how this portfolio and strategy can pay on average $200 from the first week. So grab a pen and paper or open your notes app. By the end of the video, you'll have everything you need to build a portfolio that pays you every week. But first, let's set the stage with the concept of weekly cash flow with dividend stocks. First off, dividend stocks are shares of companies that pay out a portion of their earnings to shareholders at regular intervals. Typically, these intervals are quarterly, meaning you get paid every 3 months. However, with some careful planning and the right selection of stocks, you can structure your portfolio to receive dividends every week. The key to this strategy is diversification and timing. By choosing a mix of high-yield, quarterly paying stocks that have staggering payout dates, you can ensure a steady stream of income every week. This approach not only helps in managing cash flow more effectively, but also reduces the anxiety of waiting for long periods between payouts. It's a game changer, especially for those relying on dividend income to cover regular expenses. So why is weekly cash flow so beneficial? For starters, it aligns better with most people's regular expense schedules. Bills, groceries, and other necessities don't wait for quarterly payouts, and neither should your investment income. By setting up your portfolio to pay you every week, you can manage your finances more predictably and avoid the stress of cash flow gaps. Plus, it allows for more frequent reinvestment opportunities, potentially accelerating your wealth-building process. Now, let's delve a bit deeper into the mechanics of this strategy. The first step involves identifying stocks that not only have a strong history of paying dividends, but also have payout schedules that complement each other. This means selecting stocks from various sectors to minimize risk and ensure that your income isn't overly reliant on a single industry.
Additionally, by focusing on high-yield stocks, you can maximize the amount of income generated from each payout. Another important aspect to consider is the stability of the companies you're investing in. High dividends are great, but they need to be sustainable. Companies with strong financial health and consistent earnings are more likely to continue paying dividends in the long term. It's crucial to research and select companies that have a proven track record of weathering economic downturns and maintaining their dividend payouts. With a clearer understanding of how this weekly cash flow works and its benefits, let's move on to the criteria for selecting the right dividend stocks for this strategy. Choosing the right stocks is crucial to ensure a steady and reliable income stream while minimizing risks. First, focus on high-yield stocks. High yield means higher dividends, leading to more substantial payouts. However, balance is key. While high-yield stocks are attractive, they come with higher risks. Ensure that the stocks you select have a sustainable dividend yield. The company's earnings and cash flow should comfortably cover its dividend payments. Next, consider the stability and financial health of the companies you're investing in. Look for companies with a strong track record of consistent earnings and dividend payments. Companies that have been paying dividends for many years, especially those increasing their dividends annually, are usually more reliable. This consistency indicates financial strength and a commitment to returning value to shareholders. Diversification is another key criterion. By diversifying your portfolio across different sectors, you reduce the risk of being overly dependent on any single industry. This helps protect your income stream from sector-specific downturns. For example, a well-diversified portfolio might include stocks from technology, healthcare, consumer goods, and financial sectors. This way, if one sector underperforms, others can help balance it out. By applying these criteria, high yield, financial stability, diversification, timing of payouts, growth potential, and tax considerations, you can build a robust portfolio that generates reliable weekly cash flow. This strategic approach maximizes your income, manages risks, and enhances the overall performance of your investments. With these criteria in mind, let's take a closer look at the specific stocks we've chosen for this strategy and why they make sense in our portfolio. Each of these stocks has been selected based on their high yield, financial stability, diversification potential, and strategic payout schedules. First up is VanEck BDC Income ETF, or BIZD. This ETF focuses on business development companies, which provide financing to small and mid-sized businesses. BIZD offers a high dividend yield of 11.33%, making it an attractive option for regular income. Its diverse holdings within the BDC sector also add an extra layer of risk management. Next is DHT Holdings, or DHT, a company in the oil tanker industry. DHT has a strong history of paying high dividends, supported by stable earnings from its long-term contracts. Despite the cyclical nature of the shipping industry, DHT's financial health and consistent performance make it a reliable choice. DHT has a dividend yield of 10.31%, and it pays dividends on the first week of February, May, August, and November, providing a steady stream of income. Then we have CTO Realty Growth, which is another solid pick. CTO specializes in commercial real estate, offering a diversified portfolio of income-producing properties. Its high dividend yield of 7.57% is supported by robust rental income and property appreciation. CTO's payouts are scheduled for the first week of March, June, September, and December, fitting perfectly into our strategy. Moving on, we have OneMain Holdings, or OMF. This financial services company offers personal loans and insurance products. OMF's high dividend yield of 9.27% is backed by strong earnings and prudent financial management. The company's ability to maintain consistent payouts through economic cycles makes it a valuable addition to our portfolio. OMF pays dividends in the second week of February, May, August, and November, ensuring mid-month income. Then we have Ares Capital, ARCC, a prominent BDC that provides financing solutions to middle-market companies. ARCC's high dividend yield of 9.46% and diversified portfolio make it a robust choice for regular income. The company's strong track record and financial stability further enhance its appeal. ARCC pays dividends in the second week of March, June, September, and December, providing a steady income stream. Then there's Bank of Montreal, BMO, a major financial institution with a strong dividend history. BMO offers a blend of stability and income, making it a prudent choice for dividend investors. The bank's diverse revenue streams and solid financial health support its consistent dividend payments. BMO's payout dates are in the second week of January, April, July, and October, contributing to our weekly cash flow. BMO has a dividend yield of 5.54%. Next, we have Pfizer, PFE, a leading pharmaceutical company known for its strong dividend payments. Pfizer's consistent earnings and growth potential make it a reliable income source. The company's robust financial health and market position supports its high dividend yield of 5.52%. PFE pays dividends on the third week of January, April, July, and October, ensuring continued mid-month payouts. Then there's Hercules Capital, HTGC, a BDC that provides venture debt to growth stage companies. HTGC's high yield of 10.21% and diversified portfolio of high-growth companies make it an attractive choice for dividend income. The company's strong performance and financial stability add to its appeal. HTGC pays dividends in the third week of February, May, August, and November, aligning well with our strategy. Then there's Altria Group, MO, a leading tobacco company with a long history of high dividend payments. Altria's stable cash flows and strong market position support its attractive yield of 7.68%. Despite the challenges in the tobacco industry, Altria's consistent performance and financial health make it a reliable income source. MO pays dividends in the third week of March, June, September, and December, ensuring regular payouts. Next up, we have Cogent Communications Holdings, CCOI, a telecommunications company that offers high-speed internet services. CCOI's high yield of 5.83% is backed by consistent revenue growth and strong financial management. The company's ability to maintain and grow its dividend payments makes it a solid pick for our portfolio. CCOI pays dividends in the fourth week of February, May, August, and November, providing end-of-month income. New Lake Capital Partners is next on our list, NLCP. It's a real estate investment trust focused on cannabis-related properties. NLCP offers a high dividend yield of 8.89%, supported by stable rental income and property value appreciation. The company's strong market position and growth potential add to its appeal. NLCP pays dividends on the fourth week of March, June, September, and December, fitting seamlessly into our strategy. Lastly, we have Healthpeak Properties, DOC, which is a REIT specializing in healthcare properties. DOC's high dividend yield of 5.57% is backed by stable rental income from healthcare facilities. The company's strong financial health and consistent performance make it a reliable choice for dividend income. DOC pays dividends in the fourth week of January, April, July, and October, ensuring continued end-of-month payouts. Now remember, in the end, I will explain how this portfolio and strategy are capable of paying out an average of $200 right from the beginning. By strategically selecting these stocks, we can ensure a reliable and consistent weekly cash flow. Each stock has been chosen not only for its high yield and financial stability, but also for its payout schedule, which fits perfectly into our weekly income strategy. All in all, which stocks will pay you in which month? For this portfolio, it should actually look something like Exhibit 1. Since we know what each stock pays in dividends, it should look something like Exhibit 2. So now that we've discussed the specific stocks for our weekly cash flow strategy, let's talk about how to practically implement this plan. Building a successful dividend portfolio requires careful planning and ongoing management to ensure it continues to meet your financial goals. First, you need to decide on the amount of capital you're willing to invest. This initial investment will determine the scale of your dividend income. Now, for this strategy to work, you have to invest $120,000 into this portfolio. With 12 stocks in our portfolio, you would allocate $10,000 to each stock. This even distribution ensures that no single stock dominates your portfolio, reducing risk. Once you have your capital ready, the next step is to purchase shares in each of the selected stocks. It's crucial to buy these stocks in a timely manner, ideally just before their ex-dividend dates. The ex-dividend date is the cutoff date established by a company to determine which shareholders are eligible to receive the next dividend payment. By purchasing the stock before this date, you ensure that you'll receive the upcoming dividend payout. So here's the breakdown of your return. Understanding that these stocks pay dividends quarterly, we can use a simple formula to calculate our expected payouts. The investment amount multiplied by the dividend yield divided by 4. Given that we're investing $10,000 in each stock, the calculation for each dividend payment is straightforward. Dividend payment equals $10,000 times stock dividend yield divided by 4. Let's break it down with an example. For our first stock, BIZD, which pays in January, the dividend payout would be approximately $283. But that's just the beginning. Following BIZD, we have BMO paying out $138.50, PFE with $138, and DOC providing $139. Combined, these payouts will bring your total cash flow for January to $699. This pattern continues seamlessly through February, March, April, and beyond up to December, creating a consistent cycle of monthly cash flows. Each quarter, these dividends will repeat, ensuring a steady income stream averaging around $200 a week. The most exciting part? Unlike traditional dividend investments where you might wait a month or even a year for payouts, this strategy ensures you start receiving payments from the very first week of your investment. You'll enjoy dividend income consistently, 4 times a month. If you're curious about the annual cash flow timeline, it looks something like what's shown in Exhibit 4. This exhibit lays out the monthly breakdown showing how your investments generate a reliable and predictable cash flow throughout the year.
Next, I'll show you the 3 fastest ways to drastically speed up your portfolio's growth and how you can use it to build wealth faster. 3 fastest ways to compound your portfolio. Compounding is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. Compounding is the magic of making more money from the money you already have. Think of it as planting a seed that grows into a tree, then using the seeds from that tree to plant more trees. The more trees you have, the more seeds and fruits you get, and the faster your money grows. In this video, we'll show you 3 ways to identify those compounding methods that can boost your returns and make you wealthier. One that'll increase your value by 30 times, one that'll increase your portfolio value by 70 times, and in the end, we'll show you a compounding strategy that'll boost your portfolio 140 times and add over $1 million to your portfolio. Let's get right into it. The first way to compound your portfolio is by investing in companies with high ROIC. These are the companies that reinvest their cash flow wisely and have a high ROIC, or return on invested capital. This metric shows how good a company is at turning its money to make more money, just like how many apples a tree can produce from one seed. For example, if a company has taken a loan from a bank with 10% interest, its cost of capital is 10%. Now, on that loan, the company makes a return of 15%. This 5% difference is the ROIC. The higher the ROIC, the more cash the company is getting in. If a company reinvests its cash flow at a high ROIC, it means it's using its money to grow its business and make more profits. ROIC not only reflects a company's operational efficiency, but also its ability to provide attractive returns to its shareholders. Now that you know the importance of ROIC, you need to find stocks with a high ROIC.
One way is to look for companies that have a high growth in their revenue and gross profit. Both revenue and gross profit indicate how well a company is performing in its market and how much value it's creating for its customers. To help you find such companies, here's an example of 4 stocks: Apple, Cisco, Nike, Expeditors. You can see these companies have high ROIC and growth numbers, showing they're using their cash flow efficiently and effectively to grow their business and value. Let's look at how Expeditors is doing. The company provides logistics and transportation services and has a high ROIC of 25.7%, which means that it's generating a lot of profit from its global network and operations. And these numbers are further reflected in their investment parameters like dividend growth, and most importantly, share price growth. EXPD has a current dividend yield of 1.09%, backed by a 10-year dividend growth rate of 13.18% and an average annual share price increase of 11.36%. If John invests $10,000 in a stock with a strong return on invested capital, ROIC, at the end of the first year, his portfolio will be valued at $11,246. The same portfolio after 10 years will be valued at $32,631. Now the compounding effect, thanks to the company's high ROIC, can be seen. After 20 years, the portfolio will reach $108,734. And in 30 years, the same portfolio will be valued at $371,511. This means that in 30 years, the high ROIC stock has added $315,704 in capital appreciation and $45,807 in dividends to John's portfolio. Now, these numbers double and triple with coming strategies. In the end, we'll show you a strategy that will make you a millionaire with one stock. Before adding a company to your investment list, check if they're buying other companies. This is called acquisition. Some companies buy others to protect themselves or grow, but not all acquisitions are good. If a company buys a lot to protect itself, it might mean it can't grow on its own. This can slow down your investment too. It's better if a company has good profits to make money and grow. So watch out if a company is more focused on avoiding losses than winning in the market. Defensive moves can only do so much. It's the aggressive moves that bring big rewards. The next way to compound your portfolio is to add companies that use cash flow for buybacks. Now for the second way of compounding your portfolio. We look at buybacks. This is a financial strategy by the corporations to reduce their number of shares in the market by buying it from the market. When a company buys back its own shares, there are less shares to divide the profits among, so each remaining share becomes more valuable. By using a buyback strategy, the company is saying, "We believe our shares are undervalued." This can make your shares worth more over time as there are fewer of them to go around, and your piece of profit gets bigger. For example, a company has 1 million shares outstanding, earns $2 per share, and trades at $30 per share. It has a price-to-earnings ratio of 15, that is $2 per share times 15, which equals $30. But what happens if this company buys half of its shares back? Its earnings per share will become $4. If the market continues to value the company at 15 times earnings, the stock price should trade up to about $60, a big jump in capital gains for you. But if you remain in a stock where buybacks are high, it's important to assess the overall health of the company, since a decline in earnings will ultimately take the shares down. Also important is to look at the stock buybacks relative to the cash flow the company is generating from operations. Some of the best buyback companies to look at are W.R. Berkley, Alphabet, MasterCard, Tractor Supply Company. Let's dissect W.R. Berkley's current buyback yield, which stands at 2.92%, signaling an active effort to repurchase its shares and suggesting the company's confidence in the undervaluation of its stock. That means your investment now would be more than just fruitful. Examining the recent performance, there's been a 4.89% dip in the stock price over the last year, indicating a potential decline in investor confidence or challenging market conditions. However, taking a broader perspective, the stock has exhibited a quick 117.62% increase over the past 5 years, showcasing a positive long-term trajectory. The 10-year picture is even more appealing, with an impressive growth of 265.21%, suggesting that Berkeley's strategic moves, including share buybacks, have contributed significantly to shareholder value over the past decade. For your portfolio, a company with high buybacks is good, but then at the same time, you need to be wary of the companies that pay down debt like there's no tomorrow. Paying it down too aggressively might not always be the super move you think it is. Debt can be a useful tool to finance growth and create value. For example, if a company borrows money at a low interest rate and invests it in a project that has a high ROIC, it can increase its earnings and value. However, some companies pay down debt too aggressively, even when it's not necessary. This can be a mistake because it means that the company is using its cash flow to reduce its liabilities instead of increasing its assets. Instead of paying down debt too aggressively, you should look for companies that have good debt management and high interest coverage. These companies can balance their debt and equity and use their cash flow to invest in profitable projects that can compound their portfolio quickly. Now John is looking for some good buyback stocks and finds W.R. Berkeley stock is a good choice and invests $10,000 into W.R. Berkeley. Like our last example, he wants to hold this one for 30 years as well for capital appreciation. The stock has a current dividend yield of 0.3%, backed by a 10-year average dividend growth rate of 9.51%. And most importantly, the stock has a strong 10-year average annual share price increase of 15.25%, thanks to consistent share buybacks. Based on these metrics, if John invests $10,000 in this stock with a strong buyback strategy, after just 1 year, his initial investment would be worth $11,555. Fast forward 10 years, and that same portfolio would quadruple to $42,188. After 20 years, the portfolio would have expanded to an impressive $176,386. By the time 30 years have passed, the value of the same portfolio would have surged to $733,782. In simple words, over the course of 30 years, the high share buyback meant more profit share and share price appreciation for John, which would have contributed $719,845 in capital appreciation, significantly compounding the value of his portfolio. Now we move to our final strategy to compound your portfolio: finding those companies that use their cash flow to pay their dividends and make you a millionaire. Dividends are important for your portfolio because they can help you earn more money without having to sell your shares. You can use your dividends to buy more shares of the same company or invest in other companies that can compound your portfolio quickly. This way, you can increase your number of shares and your dividend income over time. Remember that high-flying smartphone company with a killer ROIC we talked about earlier? Now you can take those dividend dollars and plow them right back into that company. It's like doubling down on a sure bet. So here's the grand scheme of things. You are in this cool compounding cycle. The dividends buy you more shares. The company keeps growing. Your shares get more valuable, and the cycle continues. It's like building a snowball of money rolling down a hill. It starts small, but it gets massive as it rolls. Now, some of the companies that you can add to your watch list are Visa Incorporated, Verizon Communications, PepsiCo, Johnson & Johnson. These are the companies that pay you a nice chunk of their profits, grow their dividends over time, and use their capital efficiently to generate more profits. Let's focus on Visa Incorporated, known by the ticker symbol V. This stock has a current dividend yield of 0.8%, backed by a strong average dividend growth rate of 18.33% and an annual share price appreciation of 16.8%. This means if John puts $10,000 into this stock, after 1 year his money grows to $11,760. In 10 years, it will increase fivefold to $50,924. This happens because the company behind the stock is great at making profits, and that helps John's money grow faster. In 20 years, John's money becomes a whopping $263,660. And after 30 years, it's even bigger at $1,393,000. In those 30 years, this stock added $1,284,076 in capital appreciation to John's portfolio and a dividend reinvestment of $98,924, all with an initial investment of just $10,000 and by selecting a good compounding stock to compound his portfolio. These compounding stock selections will help you find the best stocks for portfolio growth. You saw how your dividend income significantly increased after reaching the $100,000 mark. But why? Well, let me show you. Why your dividend income explodes after $100,000. Ever heard the phrase, the rich get richer? Well, when it comes to dividend investing, it's not just a saying, it's a reality. Once your portfolio hits that $100,000 mark, your income hits the multiplier effect. The money starts working smarter, not harder. Your dividends aren't just trickling in, they're doubling down, reinvesting themselves, and multiplying your returns. It looks almost unfair how quickly things can snowball from here. Your money's now in a self-feeding loop where every reinvested dividend buys more shares, which creates more dividends, and the cycle continues. And once it starts, it's tough to stop. But why does everything seem to explode after $100,000? Why is this number such a turning point for every portfolio? In this video, I'll walk you through exactly how to hit that $100,000 milestone using a real market stock. I'll show you why its return multiplies after reaching the first $100,000. I'll show you how to double your portfolio to the second $100,000 in just 3 years, and then add $100,000 every year after that. In the end, I'll show you how, in the long run, this snowball can reach a valuation of over $3 million. And all it takes is a one-time investment of $10,000 to get started. But first, let's set the stage. So why is that first $100,000 so important? Well, it comes down to two main factors. First, there's the challenge of building up your earning potential. Think of it like leveling up in a game. You need time and experience to increase your skills and income. Second, and perhaps more importantly, it's about understanding the power of compounding. You see, in the early stages, your money's like a small snowball. It takes time to grow. But once you hit that $100,000 mark, that snowball starts to gather speed and mass, picking up more and more as it rolls down the hill. This is when your investments start working for you in a way that feels almost magical. In simple terms, compounding is when your investment earnings generate their own earnings. When you first start investing, your returns might seem small and slow. You put in the effort, you see a little growth, but it can feel like you're just inching forward. That's because in the early stages, your investment base is relatively small. But as you keep contributing and reinvesting those dividends, your portfolio begins to grow, and the effects of compounding start to become more noticeable. Let's take a closer look at the numbers and see how this works. Let's say you're saving $10,000 annually and you're earning an 8% annual return. In the first year, that 8% return on your $10,000 amounts to $800. Not exactly a fortune, right? But remember, compounding is all about the long game. By the end of the second year, you're not just earning 8% on your initial $10,000, you're earning it on $20,800, your initial investment plus the first year's growth. That's $1,664 in the second year, a noticeable jump already. But here's where it gets exciting. By continuing to save $10,000 annually at an 8% return, you'll cross the $100,000 mark by the 8th year. At this point, your investment is now working for you, generating around $8,000 annually just from the returns alone. And the magic really starts to happen after that. Once you've hit $100,000, the snowball effect of compounding kicks in even more powerfully. As you can see, by the 9th year, your balance could be around $118,800 with $9,504 earned just from the returns that year. The returns start to compound themselves, and each $100,000 milestone is reached faster and faster. To give you a clear picture, if you continue with the same $10,000 annual contribution and 8% return, you'll hit $200,000 by around the 14th year. So while it took you 8 years to get the first $100,000, it only takes about 6 more years to reach the next $100,000. The third $100,000? Even quicker. It takes just 4 years. The acceleration is the beauty of compounding in action. This is why reaching $100,000 is such a pivotal moment. It's like hitting the gas pedal on your financial journey. The growth from compounding starts to become more significant and your portfolio begins to snowball in a way that feels almost effortless. By the end, I'll show you a stock that with a one-time investment of $10,000 takes 12 years to reach its first $100,000, adds another $100,000 in just 3 years, and then continues to grow by $100,000 each year after that. And I'll show you how in the long run, this snowball can reach a valuation of over $3 million. But there's more to it than just numbers. There's a psychological shift that happens too. Once you hit $100,000, your mindset shifts. You start to see the potential for even greater growth. You realize that the habits and strategies that got you to $100,000 can take you even further. Crossing the $100,000 threshold has a way of changing your relationship with money. You become more focused on the long term. Instead of getting caught up in short-term fluctuations, you start to see the bigger picture. You understand that building wealth is a marathon, not a sprint, and this mindset is crucial because it helps you stay the course even when the market gets rocky. But here's where things get really interesting. Once you've crossed that $100,000 line, the strategies that helped you get there start to work even more effectively. And one of the most powerful tools in your arsenal is dividend reinvestment. Dividend reinvestment is one of the simplest yet most powerful strategies you can use to grow your wealth. It's the process of taking the dividends you earn from your investments and reinvesting them back into the same stock or fund. This might sound straightforward, but the impact it can have on your portfolio's growth is anything but ordinary. When you reinvest your dividends, you're essentially buying more shares of the company or fund that's paying you. And as you buy more shares, your future dividend payouts increase, which allows you to buy even more shares. This creates a self-reinforcing cycle that can lead to exponential growth. Let's say you've reached the $100,000 mark and you're earning dividends at a 3% yield. That's $3,000 in dividends in the first year. Instead of spending that $3,000, you reinvest it, buying more shares. The next year, your dividend income isn't just based on your initial $100,000, it's based on your $103,000. This means your dividend income grows year after year, and the more you reinvest, the faster it grows. It accelerates the compounding process, allowing your portfolio to grow at a faster rate than it would if you were simply relying on capital appreciation. And the best part, this growth happens automatically with very little effort on your part. But reinvestment isn't just the only factor that contributes to the explosion of your dividend income after $100,000. There's also the matter of diversification. Diversification is a key principle of investing, and it becomes even more important as your portfolio grows. When you're just starting out, you might be focused on a few core investments, but once you hit $100,000, you have more flexibility to explore different sectors, industries, and asset classes. This not only reduces your risk, but also opens up new opportunities for growth. After reaching $100,000, you might start looking at dividend-paying stocks in different industries or even different countries. You might also consider adding other income-generating assets to your portfolio, such as real estate investment trusts. But diversification isn't just about adding new assets, it's also about optimizing the balance of your portfolio. This might mean shifting some of your investments into higher-yielding assets or reducing your exposure to riskier investments. And here's where the snowball effect really starts to kick in. Remember, in the end, I'll show you a stock that uses all these strategies to reach the $100,000 mark in 12 years, adds another $100,000 in just 3 years, and then continues to grow by $100,000 each year after that until it hits a $3 million valuation. So the snowball effect is all about compounding, earning returns on your returns. As your portfolio grows, the dividends you earn increase, and when you reinvest those dividends, you're buying more shares, which in turn generate even more dividends. The cycle continues, and over time, the growth of your portfolio accelerates. But here's the thing, this acceleration isn't linear, it's exponential. In the early stages, your portfolio might grow slowly, but as the years go by, the growth becomes more and more pronounced. This is why your dividend income can explode after $100,000. The bigger your portfolio gets, the more powerful the compounding effect becomes. There's a company that has this exponential growth opportunity for you, the United Health Group. Let's say you start with $10,000 today and invest it in United Health Group with a current dividend yield of 1.32% and a dividend growth rate of 20.34%. If you reinvested all your dividends, here's how your portfolio might grow over time. In the first year, your dividend income will be around $132. But as you reinvest those dividends and benefit from capital appreciation, your portfolio begins to grow. Let's fast forward to the point where your investment hits the $100,000 mark. This could happen around the 12th year if you're consistently adding to your investment and benefiting from capital appreciation. At this point, your portfolio is generating a dividend income of about $1,114 annually. It's significant progress from $132, but here's where things get really interesting. Once you cross that $100,000 threshold, the compounding effect becomes much more powerful. By the 20th year, your portfolio could grow to an impressive $575,463 with a dividend income of $5,218. The leap from $100,000 to $575,000 happens much faster than the climb to the initial $100,000. Why? Because at this stage, your portfolio's growth is fueled by both the reinvested dividends and the capital appreciation. The snowball has gained so much momentum that it's picking up speed on its own. And it doesn't stop there. By the 30th year, your portfolio could be worth over $4 million, generating a dividend income of $35,696 per year. Think about that for a second. What started as a $10,000 investment has grown into a portfolio that's not only massive, but also throwing off significant income year after year. This is the power of compounding at work. The longer you stay invested, the more your portfolio grows, and the faster that growth accelerates. But to reach and surpass the $100,000 mark, you need to have a solid plan in place. Don't have a huge initial investment? Here's what dividend income from $5,000 looks like, and it's more than what you might expect. Dividend income from $5,000, not what you'd think. Can a $5,000 investment really make a difference in your future? Is this investment enough to pay over $5,000 per month in dividends? In this video, I'll show you and John 5 different growth stocks, each better than the last. I'll show you how these stocks stack up and precisely how much you could earn from each one. Spoiler alert, a few stocks have the potential to make John a multimillionaire. In the end, I'll show you how you can combine these stocks into a portfolio, make it less risky, and still make over $100,000 in annual dividends. Now, to reach our goal, we need to have a solid criteria for selecting top dividend stocks. When it comes to dividend investing, not all stocks are equal. To identify the best options for John's portfolio, we consider several key factors. First, look at dividend yield. A higher yield suggests a better income stream, balanced with the company's sustainability.
Next, consider the dividend payout ratio. A lower ratio indicates potential for future growth, while a higher ratio may pose some risks. Also, analyze historical dividend growth rates with a preference for companies with consistent increases. Stability and performance are crucial as well. Focus on firms with strong balance sheets and resilience. Based on these criteria, we've identified 5 stocks offering solid dividends and long-term growth potential ranked from good to best and value creation. Let's start with our first stock. At number 5, we have Extra Space Storage with the ticker symbol EXR. This company has become a dominant player in the self-storage industry, known for its consistent performance and impressive dividend payouts. Extra Space Storage has a current dividend yield of 4.14%, which is quite attractive for income-focused investors. But what makes this stock particularly interesting is its dividend growth rate, which stands at a robust 14.52%. With a 10-year average share price appreciation of 11.47%, the company's strategic expansion and acquisition plans have further solidified its position in the market, ensuring sustained growth and profitability. Now let's look into the numbers to see how a $5,000 investment in Extra Space Storage could grow over time. If John invested $5,000 today, after 1 year his investment would be worth $5,781. Fast forward 10 years and the investment could grow to around $22,491. After 20 years, this amount will grow to $116,650. And after 30 years, John could be looking at an investment worth a staggering $730,928, paying $59,590 in annual dividends, or a monthly dividend income of about $4,966. The total value added through capital appreciation would be $415,071, while the total dividend reinvestment would contribute an additional $310,857 to John's investment. The impressive growth and solid dividend payments of Extra Space Storage make it a compelling choice for dividend investors. The company's ability to increase its dividends consistently and its strong performance in the self-storage market highlight its potential as a long-term investment. Additionally, the resilience of the self-storage industry, even during economic downturns, adds an extra layer of security to John's investment, and this is the reason why EXR made it to our list. Next, at number 4, we have the Home Depot with the ticker symbol HD. Known as the largest home improvement retailer in the United States, Home Depot has consistently delivered strong financial performance and shareholder returns. Its current dividend yield is 2.59%, and it has an impressive dividend growth rate of 17.57%. Over the past decade, the company's average share price appreciation has been 15.8%. Over the past decade, the company's average share price appreciation has been 15.8%, reflecting its robust market position and effective business strategies. To see the potential impact of investing in Home Depot, let's break down the numbers. If John invested $5,000 today, after 1 year his investment would be worth approximately $5,920. Over a decade, this investment could grow to about $27,545. After 20 years, the initial investment could expand to $158,775. And after 30 years, it could reach an astounding $965,689, paying $34,637 in annual dividends, or a monthly dividend income of around $2,886. The total value added through capital appreciation would be $768,063, while the total dividend reinvestment would contribute an additional $192,626 to John's investment. So the returns so far are good, but up next, we'll show you stocks that have the potential to reach multi-million-dollar valuations. By the end, we'll show you a portfolio of these stocks that consistently pays over $100,000 in annual dividends.
Home Depot's success can be attributed to several factors, including its dominant market position, efficient supply chain, and innovative customer service initiatives. The company's ability to adapt to changing market conditions and consumer preferences has helped it maintain its growth trajectory. This adaptability, combined with a strong financial foundation, makes Home Depot a reliable choice for dividend investors. Additionally, Home Depot has focused on enhancing its online presence and integrating digital solutions to complement its physical stores. This omni-channel approach has not only increased customer satisfaction but also boosted sales, contributing to the company's overall growth. The strategic expansion into new markets and continuous improvement in product offerings ensure that Home Depot remains a leader in the home improvement sector, hence the reason for inclusion in our portfolio. Next, at number 3, we have Lowe's Companies with the ticker symbol LO. Lowe's is another heavyweight in the home improvement retail sector, often considered a direct competitor to Home Depot. Known for its extensive range of products and strong customer service, Lowe's has carved out a significant market share in this lucrative industry. The current dividend yield for Lowe's is 2.06%. Over the past decade, the company has shown remarkable consistency in increasing its dividends, standing at 19.84%. The 10-year average share price appreciation for Lowe's stands at 17.16%. Based on these figures, if John invests $5,000 in this stock, after 1 year his investment will be valued at approximately $5,961. Over 10 years, this investment could grow to around $29,660. Fast forward 20 years and the investment has the potential to reach $186,597. Finally, after 30 years, John's $5,000 could balloon to an impressive $1,266,682, paying $46,207 in annual dividends, translating to a monthly dividend income of about $3,851. The total value added through capital appreciation would be $1,025,772, while the total dividend reinvestment would contribute an additional $235,910 to John's investment. Lowe's success is driven by its strong market position, innovative business practices, and relentless focus on customer satisfaction. The company has effectively managed to balance expansion and profitability, ensuring steady growth in shareholder value. Its ability to adapt to market trends, such as the increasing importance of e-commerce, has further strengthened its competitive edge. Next on our list is NetEase with the ticker symbol NTES. NetEase is a leading Chinese technology company known for its diverse portfolio, including online services, gaming, e-commerce, and education. The company has consistently demonstrated strong financial performance and robust dividend payouts, making it an attractive option for dividend investors. NetEase currently offers a dividend yield of 2.8% and has a remarkable dividend growth rate of 22.18%. To top it off, its 10-year average share price appreciation also stands at 19.85%. Based on these metrics, if John invests $5,000 in this stock, after 1 year his investment would be valued at $6,133. Over 10 years, this investment could grow to around $39,509. Fast forward to 20 years, and his initial investment will grow to $333,269. After 30 years, it has the potential to reach $3,050,440, paying $132,929 in annual dividends, which translates to a monthly dividend income of about $11,077. The total value added through capital appreciation would be $2,432,859, while the total dividend reinvestment would contribute an additional $612,581 to John's investment. NetEase thrives on innovation and adapts well to market shifts, bolstered by diverse revenue streams and a strong presence in China. Its investments in new technologies like cloud gaming and e-learning enhance revenue prospects. With consistent dividend growth and robust performance, NetEase offers both steady income and potential for long-term capital gains. Its proactive strategy in innovation and market expansion cements its position as a top choice for investors seeking diversified income and growth opportunities in the tech sector. Now, before showing you a portfolio of these stocks that's less risky and consistently pays over $100,000 in annual dividends, at number 1, we have Warren Buffett's favorite, Lennar Corporation, with the ticker symbol LENB. Lennar is one of the leading home builders in the United States, known for its diverse range of homes and strong market presence. The company's been a consistent performer, delivering solid returns to its shareholders through both dividends and capital gains. Lennar currently offers a dividend yield of 1.4%, and it has an exceptional dividend growth rate of 27.03%. And the 10-year average share price appreciation for Lennar stands at 15.42%. Lennar's success can be attributed to its ability to navigate the cyclical nature of the real estate market effectively. The company has focused on diversifying its product offerings and expanding into new markets, which has helped it maintain steady growth. Additionally, Lennar's investment in technology to enhance its construction processes and customer experience has positioned it as a leader in the home building industry. Investing in Lennar offers the dual benefits of a growing income stream and substantial long-term capital gains. Let's break down the potential returns from a $5,000 investment in Lennar. After 1 year, John's investment would be worth approximately $5,841. Over 10 years, the investment could grow to about $25,791. Fast forward to 20 years, and John's initial investment has the potential to reach $198,366. After 30 years, that $5,000 investment could reach an impressive $4,601,537, paying $1,043,417 in annual dividends, translating to a monthly dividend income of about $86,951. The total value added through capital appreciation would be $1,717,306. While the total dividend reinvestment would contribute an additional $2,879,231 to John's investment. So, these numbers look great, right? But does this mean you should go all in on LENB? Well, the correct answer to that is a big no. Even though LENB has the highest portfolio valuation and dividend payout, putting all your eggs in one basket is a big no in the investing world. So what's the solution here? The answer is a well-diversified portfolio. By combining all the stocks, you can achieve a balanced portfolio that leverages the strengths of each stock. This combined portfolio results in some impressive metrics, which you can calculate by adding the respective percentages, then dividing by 5. The portfolio's current dividend yield stands at 2.6%, with an average dividend growth rate of 20.23% and a 10-year share average growth of 15.94%. So let's break down the potential returns from a $5,000 investment spread equally across these 5 stocks. After 1 year, the total portfolio value would be approximately $5,927. After 10 years, the portfolio will grow to around $28,715. Fast forward 20 years, and the investment could reach $189,211. Finally, after 30 years, the portfolio has the potential to reach an impressive $1,531,340, paying $107,789 in annual dividends, or a monthly dividend income of about $8,982. the total value added through capital appreciation would be $1,041,482, while the total dividend reinvestment would contribute an additional $484,858 to the portfolio's overall value. Even though this valuation is lower than our top pick, the combined portfolio return will be more consistent than any one stock alone. If you want to start with even less than $5,000, let's say $120, then next, I'll show you how investing just $120 a week into SCHD can eventually surpass your full-time income. $120 a week into SCHD will surpass your full-time job. Ever feel like your paycheck disappears before you even get a chance to enjoy it? And when it comes to thinking about retirement, it seems like you need a fortune just to live comfortably. But here's the thing. You don't need millions in investment to surpass your current job. Today, I'm going to show you how investing $120 a week into SCHD could not only solve your paycheck struggles, but also set you up for retirement. I'll explain how it can snowball into a portfolio value of over $2 million, and in the end, I'll show you how $120 a week can help you achieve annual dividend earnings of over $180,000, which translates to a monthly income of over $15,000. First things first, what exactly is SCHD? Schwab U.S. Dividend Equity ETF, or SCHD, was launched in 2011, and since then, it has become one of the most popular dividend-focused ETFs available. With a focus on U.S. companies that have a strong history of paying dividends, SCHD combines the stability of large, well-established companies with the potential for long-term capital gains. This ETF is designed to track the Dow Jones U.S. Dividend 100 Index, which selects its holdings based on strict criteria. SCHD is all about combining consistent dividend income with the potential for capital appreciation. It's structured to invest in companies with a strong history of paying and growing their dividends, which makes it appealing for both income investors and those looking to grow their wealth over the long term. What makes the ETF unique is its balanced approach to dividend investing. Rather than focusing solely on high dividend yields, which can sometimes come with higher risk, it emphasizes quality. The fund includes companies that are not only paying dividends, but are also financially healthy and have a strong track record of increasing dividends over time. This focus on quality ensures that investors are not exposed to the riskier high-yield dividend stocks that might cut dividends during difficult times. You might be wondering, how does SCHD decide which companies to include? Well, it all comes down to a very deliberate selection process based on a specific set of criteria. SCHD follows the Dow Jones U.S. Dividend 100 Index, which ranks companies based on their financial health, dividend yield, and dividend growth. To be included in the index, companies must meet 3 requirements. First, companies must have a history of paying dividends for at least 10 consecutive years. This makes sure that only companies with a strong commitment to returning capital to shareholders are included. Secondly, dividend growth. Beyond just paying dividends, companies must also show a history of growing their dividends over time. This is crucial because it shows that the companies are not only able to pay dividends, but are also increasing those payments as their businesses grow. Lastly, their financial strength. Companies are evaluated based on financial metrics such as return on equity and free cash flow, ensuring that only financially strong companies are included in the fund. When you invest in SCHD, you're investing in a diversified portfolio of 100 high-quality U.S. companies across various sectors. The holdings are spread across industries like financials, healthcare, consumer staples, and technology. This diversification is key because it reduces your exposure to any single sector, providing a cushion against downturns in specific industries. Some of the top holdings include well-known companies like the Home Depot, BlackRock, Cisco Systems, Lockheed Martin Corporation, Pfizer, Verizon Communications, and Texas Instruments. These are large, established companies with a strong track record of paying and growing dividends. For example, the Home Depot is one of the largest home improvement retailers in the world, and it has 32 years of history increasing their dividends. Pfizer, a leading pharmaceutical company, is another notable holding that provides a stable source of income for investors. Texas Instruments, known for its leadership in semiconductor technology, is also a top holding, offering both growth potential and reliable dividends. SCHD's holdings are carefully selected to balance stability and growth. By investing in companies across various sectors, the fund minimizes risk while providing exposure to companies with strong dividend growth possibilities. Speaking of growth, let's see where SCHD has been performance-wise. One of the most compelling reasons to invest in SCHD is its strong historical performance. Since its inception in 2011, the ETF has consistently delivered solid returns, both in capital appreciation and dividend income. Let's compare it with a broader index like the S&P 500 if you're wondering how it stacks up in terms of performance and income potential. Over the past 10 years, SCHD has provided a price return of over 120%. While this may not be as high as the S&P 500, which returned around 200% over the same period, SCHD offers the added benefit of a higher dividend yield. This makes it particularly attractive for income investors who are looking for a steady stream of income while also growing their capital. SCHD's dividend growth has been equally impressive. The fund's dividend yield currently stands at around 3.41%, and its 5-year dividend growth rate, or CAGR, is 12%. This means that not only are you receiving a healthy dividend yield, but those dividends are also growing at a significant rate over time. In terms of overall performance, SCHD has proven itself to be a reliable choice for long-term investors. While it may not offer the same level of capital appreciation as the S&P 500, its combination of dividend income and growth potential makes it a solid option for those looking to build wealth steadily. But does it have what it takes to hit a 6-figure valuation? That's what we'll see in the end. And also, I'll show you how it can turn a $120 per week investment into a portfolio that pays over $180,000 in annual dividends. One of the key factors contributing to SCHD's strong performance is its focus on high-quality dividend-paying companies. These companies tend to be more stable and financially healthy, which helps protect against downside risk during market volatility. This brings us to the risk profile of the ETF. SCHD has a relatively low expense ratio of 0.06%, which helps enhance overall market returns by reducing costs. Moreover, its volatility, measured by the beta, is lower than that of the broader market. This means SCHD tends to experience smaller price swings compared to the overall market, making it a less risky investment option. SCHD is currently priced at $28.55 per share. And don't be afraid, the stock price didn't plummet. They recently executed a 3-for-1 stock split, which took effect this October. The split resulted in the price per share adjusting to approximately $28.34 from a pre-split price of around $85.02. However, it's important to note that such a split doesn't alter the total value of investors' holdings, but rather increases the number of shares each investor holds, making the shares appear more affordable without changing the fundamental value of the investment. The ETF has a price-to-earnings ratio of 5.42 and a PB ratio of 2.85, which is relatively good compared to the broader market, suggesting that it's not overpriced. Its focus on fundamentally strong companies like Home Depot, Cisco Systems, AbbVie, Amgen, and Chevron underpins its stability amidst market volatility. Now let's get into the exciting part. How can investing just $120 a week into SCHD eventually surpass your full-time job income? The key here is consistency and the power of compounding. By investing $120 a week into SCHD, you're not only taking advantage of capital appreciation, but also building a growing stream of dividend income. As the companies in SCHD's portfolio continue to grow and increase their dividends, your income will grow as well. Over time, this steady investment, combined with the growth in dividends, can lead to significant wealth accumulation. The beauty of this strategy is that it accelerates the compounding process. Instead of spending your dividends, you're reinvesting them to buy more shares, which in turn generates even more dividends. Over time, this can lead to exponential growth in both your portfolio value and your income. Now let's take a look at the real potential of consistently investing $120 a week into SCHD and how it can completely transform your financial future. At first, $120 might not seem like a huge amount, but when you break it down, it's all about consistency. By investing $120 every week, you're setting yourself up for long-term success because those small contributions add up. Here's how. $120 a week multiplied by 52 weeks in a year totals $6,240 annually. Now, if you and John invest $120 per week in SCHD, here's what the future projections will look like. After 5 years, your portfolio will be valued at $40,136. In 10 years, it'll be valued at $114,969, while your investment at that point will stand at $62,400. This is the point when the gap between the amount invested and the ending portfolio value starts to increase significantly. After 20 years, your portfolio will be valued at $558,233. Give it 10 more years, and by the 30th year, by the time you retire, your portfolio will be valued around $2,628,133, with your total investment standing at approximately $187,200. What's interesting here is the dividend amount. By the 30th year, you and John will be paid $185,457 in annual dividends. So by the time you're retired, you're effectively receiving in dividends each year the same amount that you invested over the 30 years. This dividend amount equates to around $15,455 in monthly income, making it safe to say that $120 invested in SCHD is more than enough to surpass your full-time job income. Reaching retirement with this kind of income could effectively serve as your pension. SCHD is a great dividend investment, but there's an even better option: REITs. What if you invested $10,000 into the 3 best REITs? What if you invest $10,000 in the 3 best REITs? Ever wondered how to transform $10,000 into a $1 million investment portfolio? What if I told you that this investment could potentially grow to $5 million? Sounds like a dream, right? Well, this dream can become a reality with 3 solid dividend REITs. In this video, I'll show you and John 3 of the absolute best REITs currently on the market. I'll break down their business models, financial performance, and future prospects to understand how these investments can help you achieve your financial goals. I'll show you a REIT that has the potential to pay over $80,000 in monthly dividends. And in the end, I'll show you a portfolio of the 3 best REITs that has the potential to make John a multimillionaire and pay over $350,000 in annual dividends. Now, before we get into the specifics of each REIT, let's talk about how I selected them. Investing isn't just about picking popular names, it's about making informed decisions based on solid criteria. Here's how I chose my top 3 REITs. First, I look at dividend yield. A high yield means you're getting a good return on your investment right from the start, but it's not just about the yield today. You also have to consider dividend growth. Consistent growth indicates a REIT's ability to increase payouts over time, which is crucial for long-term investors. After that, you need your investment to also grow in value by means of share price appreciation. For this, you also have to consider the 10-year average share price appreciation. Based on these criteria, coming up next are the 3 best REITs ranked from the good to highest value addition to your portfolio. Starting at number 3, we have Extra Space Storage. Known by the ticker symbol EXR, Extra Space Storage is a fascinating player in the world of REITs. This company has carved out a niche in the self-storage industry. Now, you might be thinking, self-storage? Really? But this sector has been booming, and EXR is leading the charge. Extra Space Storage operates over 3,500 facilities across 43 states, making it one of the largest self-storage companies in the U.S. Their business model is simple, yet highly effective. They provide secure, clean, and convenient storage solutions for both personal and business needs. So, let's dig into the numbers. EXR currently has a dividend yield of 4.33%, which is quite impressive. But that's not all. The real return lies in their dividend growth rate, which stands at a robust 15.01%. This means your dividend payouts are not only stable, but also growing significantly over time. And there's more. When we look at the 10-year average share price appreciation, EXR shines with an impressive 10.9%. This indicates that the stock price has been growing steadily, adding substantial value to your investment. To give you a clearer picture, let's look at the future projections. If John invests $10,000 in EXR today, in 1 year, his investment is projected to grow to $11,523. Not bad for a year, right? Fast forward to 10 years, and you could be looking at $44,578. Keep that investment for 20 years, and it could grow to a nice balance of $247,814. And if you're in it for the long haul, after 30 years, your initial $10,000 investment could balloon to an astounding $1,899,993. That's almost $2 million from a starting investment of $10,000. And let's not forget about the dividends. After 30 years, you'd be receiving $212,120 annually in dividends, or about $17,677 every month. The total value added to your investment would be around $1,889,993, with $909,660 coming from capital appreciation and $980,333 from reinvested dividends. It's clear that EXR not only offers solid immediate returns, but also positions you for significant long-term gains. Analyst sentiment is also in our favor. The quant rating for EXR is a solid buy, which is also backed by Wall Street analysts. Even Seeking Alpha analysts give it a hold, indicating a general consensus of its strength and potential. These ratings reflect confidence in EXR's business model, growth prospects, and overall market position. Next up, at number 2, we have another promising REIT, Rexford Industrial Realty, known by its ticker symbol REXR. This REIT focuses on industrial properties, specifically in the Southern California market. Now, why is that a big deal? Southern California is one of the most dynamic and high-demand industrial markets in the world. With the constant stream of goods flowing through places like the ports of Los Angeles and Long Beach, it's a logistics powerhouse. Rexford Industrial owns and operates a huge portfolio of high-quality industrial properties, including warehouses, distribution centers, and light industrial facilities there. These assets are strategically located near key transportation hubs, making them extremely valuable for businesses that need to move products quickly and efficiently. This prime real estate positioning not only ensures high occupancy rates, but also allows Rexford to command premium rents. As for the investment metrics, the current dividend yield for Rexford Industrial is 3.79%, which might seem modest compared to some high-yield REITs, but it's the growth that really matters. REXR has an impressive dividend growth rate of 16.79%. This rapid growth indicates that the company's not only committed to rewarding its shareholders, but is also generating increasing amounts of cash flow to support these payouts. Looking at the historical performance, the REIT's 10-year average share price appreciation is an outstanding 12.09%. So what does this mean for your investment? If John put $10,000 into this REIT today, his investment is projected to grow to $11,588 in 1 year. Over 10 years, that investment could grow to $47,209, which more than quadruples the initial amount. Fast forward 20 years, and you could be looking at $280,989. And if you're thinking really long-term, after 30 years, that $10,000 investment could potentially grow to an impressive $2,387,661. paying $271,115 annually in dividends, which translates to about $22,593 every month. To break it down, the total value added to your investment would be around $2,377,661, with $1,195,802 coming from capital appreciation and $1,181,859 from reinvested dividends. If you think this is good, wait till you see the top REIT that has the potential to double this valuation. And in the end, I'll show you a portfolio of the 3 best REITs that has the potential to make John a multimillionaire and pay over $350,000 in annual dividends. Analyst sentiment further reinforces the strength of REXR. The quant rating is a hold, indicating cautious optimism. However, Seeking Alpha analysts rate it as a buy, and Wall Street analysts also give it a buy rating. This positive outlook from experts suggests confidence in Rexford's ability to continue delivering strong performance and shareholder value. Okay, quick reveal. If you're wondering where I get all that data from, let me tell you about our channel's official partner, Seeking Alpha. It's been my go-to tool for winning in investments. It's easy and simple, and I love how I can access under-the-radar investing ideas, earnings call transcripts, and breaking news. Plus, the exclusive database stock ratings have been a game changer. Stocks rated strong buy and their alpha picks have beaten the S&P 500 by over 80%. So, do yourself a favor and check them out in the description. As a bonus, they've promised to give a 20% discount on premium membership, with a 7-day free trial and a 10% discount on alpha picks to those in our community who join using the link from the video description. Now, back to our video. Let's take a look at our top REIT pick, CubeSmart. This REIT has some impressive numbers and a solid business model that you'll definitely want to know about. Known by its ticker symbol, CUBE, CubeSmart is a leader in the self-storage industry, operating a massive network of storage facilities across the United States. The company's business model is centered on providing convenient and secure storage solutions for both personal and business needs. Whether you're looking to store household items, business inventory, or even vehicles, CubeSmart has a facility to meet your needs. CubeSmart's extensive reach with hundreds of locations strategically placed in high-demand areas ensures a steady flow of customers, and consequently, a robust income stream. Their focus on customer service and facility maintenance has earned them a strong reputation, which translates into high occupancy rates of about 90% and the ability to command premium rents. Let's break down the financial metrics that make CubeSmart an attractive investment. CubeSmart currently offers a dividend yield of 4.8%, which is quite compelling, backed by a strong dividend growth rate, which stands at an impressive 15.34%. And with a 10-year average share price appreciation of 8.69%, it becomes clear why CubeSmart is a top choice. This figure indicates steady growth in the value of your investment, adding another layer of return on top of the dividends. Listen, a company that can grow its share price consistently over a decade and maintain a good starting dividend yield is a strong candidate for long-term investment. Now let's talk about projections. If John invests $10,000 in CubeSmart today, that investment is expected to grow to $11,349 in 1 year. This initial growth is promising, but the long-term projections are where CubeSmart truly shines. Over 10 years, the same investment could grow to $41,190. Fast forward 20 years, and you might be looking at $279,104. And if you're in it for the long haul, after 30 years, your initial $10,000 investment could balloon to an astounding $4,571,595. Paying $1,015,882 in annual dividends, which breaks down to approximately $84,657 per month. The total value added to your investment would be around $4,561,595, with $1,158,911 coming from capital appreciation and $3,402,684 from reinvested dividends. So the question is, should you just invest all your money in Cube? The answer to that is no. Investing in these REITs is a great opportunity, but like any investment, stocks have risks, and you cannot put all of your eggs into one basket. To minimize these risks, diversifying your investment is crucial. That's where the portfolio comes in. If you choose the REITs mentioned above and invest an equal amount in each, you can calculate some key metrics to assess your portfolio's performance. All you have to do is add the respective yield percentages and divide by 3, and you'll have your portfolio's average dividend yield, dividend growth, and annual growth. For this portfolio, we'll get an average current dividend yield of 4.31%. A strong dividend growth rate of 15.71%, and an average annual growth rate of 10.56%. So based on these metrics, let's say John invests $10,000 in this portfolio of REITs. In 1 year, this investment is projected to grow to $11,487. Over 10 years, it has the potential to grow to $44,161, which more than quadruples your initial amount. Fast forward 20 years, and you could be looking at $263,812. In 30 years, the $10,000 investment has the potential to reach a value of $2,546,624 and pay $365,023 in annual dividends, which breaks down to about $30,419 every month. Not quite over $80,000 like our last REIT, but definitely safer than investing everything in one stock. In total, the total value added to your portfolio after 30 years would be around $2,536,624. This includes $1,036,689 from capital appreciation and a solid $1,499,934 from reinvested dividends.
If you have a larger budget and want to play it safe, here's what happens when you put $100,000 into the best Fidelity Index funds. Let's break it down. What if you invest $100,000 in the 5 best Fidelity Index funds?
You've got $100,000, and instead of letting it sit in a bank earning pennies, you question what's the best way to invest it without spending hours staring at stock charts, and put it to work. But not just anywhere. You're eyeing 5 powerhouse Fidelity Index funds. Now, what if I told you that this decision could take that $100,000 and turn it into something truly extraordinary? I'm not talking about small gains, I'm talking millions. In this video, I'll show you and John the 5 best Fidelity Index funds to invest $100,000. I'll also show you how much it can return over 10 years and 20 years. I'll show you funds that pay over $25,000 in monthly dividends. And in the end, I'll show you a Fidelity fund that has the potential to turn a $100,000 investment into a portfolio valued at over $20 million. When it comes to choosing the right index funds, it's not just about picking the biggest names or the highest returns, there's a strategy behind it. The 5 Fidelity Index funds I'm showing you today are carefully selected based on a few key criteria: growth potential, dividend yield, sector performance, and long-term stability. Coming up are the top 5 Fidelity Index funds ranked from good to absolute best for their potential to add serious value to your portfolio. Starting at number 5, we have the Fidelity MSCI Consumer Staples Index ETF with the ticker symbol FSTA. This is a fund that lets you invest in the essentials, the backbone of the economy. This index fund is heavily weighted toward consumer defensive stocks, meaning it includes companies that provide goods and services people can't live without, no matter the state of the economy. FSTA's top holdings read like a who's who of consumer staples. Procter & Gamble, Costco, Walmart, and Coca-Cola dominate the list, making up over 63% of the fund. These companies have a strong brand recognition, solid global operations, and a proven track record of weathering economic downturns. The fund focuses entirely on consumer defensive stocks, with over 98% of its assets in this sector. FSTA is a reliable income generator with a current dividend yield of 2.39%. Its 10-year dividend CAGR of 10.7% is even more impressive, showing that it's been consistently increasing its dividend payouts over the long term. With a record of 10 consecutive years of dividend payments and 7 years of growth, FSTA is a solid choice for balancing income with capital preservation. For example, during the 2008 financial crisis, consumer staples fell by only 15%, while the S&P 500 dropped by over 38%. This stability, combined with steady growth, makes FSTA a compelling choice for conservative investors like John who value both safety and long-term results. Let's talk about what happens if John invests $100,000 in FSTA. Historically, FSTA has delivered an average annual return of 6.41%, reflecting its focus on staple essential goods. After 1 year, John's investment could grow to approximately $108,800. Fast forward 10 years, and his investment might reach around $243,730. If he holds on for 20 years, the value could rise to about $681,853. And after 30 years, John could see his investment balloon to $2,344,387. Not only that, but the annual dividends by year 30 could provide John with an income of $165,461, or about $13,788 per month. Over these 30 years, the total value added to John's portfolio would be approximately $2,244,387 from capital appreciation and $1,097,419 from dividend reinvestments. At number 4, I have the Fidelity MSCI Consumer Discretionary Index ETF, ticker symbol FDIS. Unlike consumer staples, the consumer discretionary sector includes companies whose products and services are considered non-essential, like luxury goods, entertainment, and leisure activities. FDIS is all about growth and innovation, capturing the dynamic consumer discretionary sector. This fund invests in companies that thrive when consumers have disposable income to spend on non-essential goods and services. It's the perfect fund for those looking to tap into the spending habits of a booming economy. FDIS is heavily weighted towards industry leaders like Amazon, Tesla, and Home Depot, with these three alone comprising almost 39% of the fund. The fund's allocation to consumer cyclical stocks makes up 96% of its holdings, meaning it's highly leveraged to sectors that can experience explosive growth when the economy is strong. Although FDIS isn't primarily an income-focused fund, with a dividend yield of just 0.76%, it compensates with solid growth. The fund has an impressive 10-year dividend CAGR of 11.22%, showing that it's steadily increasing its payouts, even if the initial yield is modest. With a history of 10 consecutive years of dividend payments, FDIS still offers a growing income stream for long-term investors. Just like they did during the 2010 to 2020 period, the sector returned an average of 16% per year, compared to the S&P 500's 13%. Now, let's see what happens if John puts $100,000 into FDIS. After 1 year, John's investment could grow to about $112,190. In 10 years, this could swell to approximately $315,693. If John holds on to this fund for 20 years, his investment might grow to around $995,230. And after 30 years, it could explode to $3,133,203. By then, John could be earning nearly $20,000 in annual dividends, translating to around $1,665 per month. Over 30 years, the total value added to John's portfolio could be approximately $3,033,203 from capital appreciation and $181,172 from dividend reinvestments. The sector's sensitivity to economic growth makes it a powerful engine for long-term wealth accumulation, perfect for an investor like John looking to capitalize on economic booms. Now, if you think those returns are impressive, just wait. At the end, I'll show you a Fidelity fund that has the potential to reach that valuation in just 20 years and has the potential to exceed $20 million in valuation over the long run. Next up, at number 3, is the Fidelity MSCI Healthcare Index ETF, ticker symbol FHLC. This fund covers the healthcare sector that always stays in style with consistent demand regardless of economic cycles. This stability is desirable to investors looking for a mix of security and growth. The sector's performance during downturns such as the 2008 crisis, when it declined by only 22% compared to the S&P 500's 38% drop, underscores its defensive nature. FHLC is dominated by heavyweights like Eli Lilly, United Health Group, and Johnson & Johnson, with these top 3 holdings making up over 25% of the fund. Almost 100% of FHLC's assets are invested in healthcare stocks, making it a pure play on the sector. This concentration in healthcare offers stability, especially during uncertain economic times when demand for healthcare services remains steady. FHLC offers a modest dividend yield of 1.26%, but what sets it apart is its impressive 10-year CAGR of 16.18%, showing that dividend payouts have been snowballing, which is crucial for income-focused investors. With 10 years of consecutive dividend payments, this fund has a strong track record of rewarding its investors. If John invests $100,000 in FHLC, here's what he might expect from an average annual return of 9.24%. After 1 year, John's investment could be worth $110,500. In 10 years, it could grow to about $283,315. 20 years in, John might see his investment reach around $931,021. After 30 years, it could skyrocket to $4,063,315. By then, John could receive annual dividends of $303,540, or about $25,295 per month. The total value added to John's portfolio over 30 years could be $3,963,315 from capital appreciation and $1,581,019 from dividend reinvestments. Taking the second spot, I have the Fidelity NASDAQ Composite Index ETF, ticker symbol ONEQ. Now, if you're looking to ride the wave of technological innovation and market disruption, ONEQ is the fund for you. This ETF tracks the NASDAQ Composite Index, which includes some of the world's most innovative and fastest-growing companies. It's a bet on the future, focusing heavily on tech and growth-oriented stocks. This index has historically outperformed many other indices, especially during technological advancement. For example, from 2010 to 2020, the NASDAQ returned an average of 17.5% per year, well above the S&P 500. So if John decides to invest $100,000 in ONEQ, this fund isn't a big dividend payer with a yield of just 0.64%. But it's been steadily increasing its payouts with a 10-year dividend CAGR of 7.35%. It's also delivered an impressive average annual return of 14.44%, driven by its focus on technology and growth-oriented companies. After 1 year, John's investment could grow to around $115,080. 10 years later, his investment might be worth approximately $401,400. If John holds on for 20 years, the value could rise to about $1,577,234. And after 30 years, his investment could reach a staggering $6,134,377. By then, John could be earning around $4,063 in annual dividends. Over 30 years, the total value added to John's portfolio could be approximately $6,034,377 from capital appreciation and $56,635 from dividend reinvestments. ONEQ is heavily weighted towards tech giants like Apple, Nvidia, and Microsoft, which includes nearly 40% of the fund. Technology accounts for over half of the fund's assets, with other significant allocations to communication services and consumer cyclical sectors. This gives investors exposure to industries that are driving the modern economy. And finally, at number 1, we have the Fidelity MSCI Information Technology Index ETF, ticker symbol FTEC. FTEC is the ultimate choice for tech enthusiasts. This fund gives you concentrated exposure to the information technology sector, investing in the companies that are shaping the future. If you believe in the transformative power of technology and its ability to drive market growth, then FTEC is the perfect choice for you. FTEC's top holdings include the tech titans Apple, Microsoft, and Nvidia, which together make up nearly 50% of the fund. With 99.42% of its assets invested in technology stocks, this fund is all about capturing the explosive growth potential of the tech industry. From software and semiconductors to cloud computing and AI, FTEC covers the entire tech spectrum. While FTEC's current dividend yield is a modest 0.66%, its 10-year dividend CAGR is an impressive 19.08%. This rapid growth in dividend payouts indicates that the companies within this fund are reinvesting for growth and returning value to shareholders. For long-term investors, this means a growing income stream alongside capital gains. If John invests $100,000 in FTEC, the potential returns are remarkable because of its CAGR, an average annual return of 18.67%. After 1 year, John's investment could grow to $119,330. In 10 years, his investment might reach around $586,063. If he stays invested for 20 years, the value could rise to about $3,442,790. And after 30 years, John's investment could skyrocket to an incredible $20,274,062. By the end of that period, John could be earning annual dividends of $126,172, or about $10,514 per month. The total value added to John's portfolio over 30 years could be $20,174,062 from capital appreciation and $757,359 from dividend reinvestments.
So that was all about playing it safe for retirement. But if you're in your early 20s, here's how you can earn the same with just a $25 a week investment. How to make $5,000 a month with only $25 a week. Looking to make some extra cash without breaking the bank? With just a small investment of $25 per week, you can start your journey to earning over $5,000 a month. Yes, you heard that right. It's possible. In this video, I'll show you and John simple and practical tips that investors keep secret. I'll show you the drip strategy and how you can make it even better. And in the end, I'll show you how using this strategy, you can turn a $25 per week investment into an over $500,000 portfolio paying over $5,000 in monthly dividends. So grab your $25 and let's get started on the path to financial success. Everything needs a strategy. You need to plan out what you need and how to get there. The same is the case with investing. In our case, our goal is to retire and still have free monthly payments as if you never retired from a job. But the problem is, we only have $25 per week to spare. So the only strategy for this is using the DRIP investment strategy. DRIP, or Dividend Reinvestment Plan, is a smart way to grow your investments over time. Think of it like planting a seed and watching it grow into a mighty tree. Instead of soil and water, you use your dividends to buy more shares, which then generate more dividends, creating a cycle of growth. Here's how it works. Imagine you own shares in a company that pays dividends. Instead of taking those dividends as cash, you reinvest them to buy more shares. This means you own more shares, which in turn generate even more dividends. It's like a snowball rolling down a hill, getting bigger and bigger with each revolution. One of the key benefits of DRIP is compound interest. When you reinvest your dividends, you buy more shares, and when those shares pay dividends, you reinvest them as well. This snowball effect leads to exponential growth over time. Let's break it down with an example. Suppose there's a stock that's worth $20 per share and you own 100 shares of that company. It pays a $1 dividend per share each year. At the end of year one, you'll have $100 in dividends. Instead of cashing out, you reinvest and buy 5 more shares of the stock. Now you have 105 shares of the company. The next year, instead of receiving $100, you'll get $105 in dividends. The following year, you'll own 110 shares, then 120, and so on, each time increasing the dividend amount. Over time, your investment grows larger and larger thanks to the power of compound interest. Another benefit of DRIP is dollar cost averaging. Instead of trying to time the market, you buy shares regularly regardless of whether the market is up or down. This helps to smooth out the highs and lows, averaging out the cost per share over time. Let's see how this works. Suppose you invest $100 every month in a company's DRIP. Some months, the share price might be high, so you'll buy fewer shares. In other months, the share price might be low, so you'll buy more shares. Over time, your average cost per share will be somewhere in between, helping to reduce the impact of market fluctuations. Finally, DRIP offers the convenience of automatic investment. Once you set up a DRIP with your broker, it takes care of everything for you. You don't have to worry about manually reinvesting your dividends or timing your purchases. It's a streamlined process that helps you stay focused on your long-term goals. In the end, I'll show you how this DRIP strategy can turn a small investment of $25 per week into over $500,000 portfolio that pays over $5,000 per month. But for that, you need to improve the DRIP strategy. Now here's how you can supercharge the DRIP investing strategy by contributing a set amount every week, month, or year. For this video, I'm investing $25 per week in my portfolio. That's $100 per month or $1,200 per year. Let me break down how this investment can make a significant impact on my investment journey. Firstly, by increasing my contribution to $25 per week, I'm accelerating the pace at which I buy more shares. With more money going into my portfolio regularly, I'll be able to purchase additional shares more frequently. This means I'll benefit from compounding at a faster rate as each new share I acquire starts generating dividends sooner. Adding more money every week helps you take better advantage of dollar cost averaging. This means I spread out my purchases over time, so I buy shares when prices are high and when they're low, reducing the impact of big price swings. Putting in $25 each week is simple, and it fits into my budget without trouble. And with DRIP, I don't have to worry about remembering to invest. It's done automatically. By using DRIP and adding money regularly, I'm setting myself up for more growth. My portfolio should keep getting bigger over time as I keep putting money in and reinvesting dividends. Now, when it comes to building a successful DRIP strategy, choosing the right stocks is key. By selecting stocks that meet specific criteria, you can ensure the effectiveness of your DRIP investments and maximize long-term returns. For me, I look into these 4 categories of stocks for my investment: blue-chip dividend stocks, dividend aristocrats, high-yield dividend stocks, and growth-oriented dividend stocks. In the end, I'll show you a selection of stocks using these criteria that utilize the DRIP strategy and have the potential to turn a small investment of $25 per week into over $500,000 portfolio that pays over $5,000 per month. But first, let's see why these categories of stocks matter. Blue-chip dividend stocks are a popular choice for DRIP investors. These are reputable companies with a long history of consistent dividend payments, indicating financial stability and reliability. Examples include household names like Coca-Cola, Johnson & Johnson, and Procter & Gamble. You need to start with blue-chip dividend stocks for your portfolio. They provide a solid foundation for long-term growth because these companies have proven their ability to generate steady income and reward shareholders with dividends. Secondly, dividend aristocrats are another category of stocks ideal for DRIP investing. These are companies that have increased their dividends for at least 25 consecutive years, showcasing a strong commitment to returning value to shareholders. Stocks like AT&T, ExxonMobil, and Walmart fall into this category. You need aristocrats to stabilize your investment strategy over a long period of time. Since these stocks have been increasing dividends for over 25 years, they're not likely to cut back anytime soon. These companies have a proven track record of navigating various market conditions and delivering consistent returns to shareholders. Additionally, high-yield dividend stocks offer another avenue for DRIP investors to explore. These stocks typically have higher than average dividend yields, making them attractive for income-focused investors. Examples include Realty Income Corporation, AbbVie Incorporated, and Verizon Communications. While high-yield dividend stocks may carry more risk compared to blue-chip or dividend aristocrat stocks, they make up an important part of the portfolio. Lastly, growth-oriented dividend stocks combine the benefits of capital appreciation and dividend income. These are companies with strong growth prospects and tend to keep increasing dividends to investors. Examples include technology giants like Microsoft, Apple, and Visa. If you're selecting stocks using these criteria, it'll narrow down the list of available stocks, so make sure your stock ticks at least 3 of the above 4 boxes. Based on the above criteria, I've selected the following 5 stocks to boost my portfolio. It includes NextEra Energy, Starbucks, Abbott Laboratories, The Home Depot, and finally, to combine them all, ProShares S&P 500 Dividend Aristocrats ETF. Separately, their current dividend yield, dividend growth, and share price appreciation look something like this. NextEra Energy Incorporated has a current dividend yield of 2.76%, a dividend growth rate of 10.98%, and an annual share price appreciation of 11.98%. Starbucks Corporation is at 3.01%, 16.69%, and 7.89%. Abbott Laboratories at 2.1%, 11.4%, and 10.31%. The Home Depot is at 2.59%, 17.91%, and 16%, while ProShares S&P 500 Dividend Aristocrats ETF has a current dividend yield of 2.04%, a dividend growth rate of 20.48%, and an annual share price appreciation of 8.17%. If we create a portfolio, our portfolio metrics might look something like this. You can calculate this by simply summing all the individual metrics, then dividing by 5. Do the same for current dividend yield, growth, and share price appreciation. With that, the portfolio has a current dividend yield of 2.5%, a dividend growth rate of 15.49%, and an annual share price appreciation of 10.87%. Now the question is, can this portfolio return enough over time for you to retire? Let's find out. If John invests $25 every week into this portfolio, which amounts to $100 per month or $1,200 per year, in this scenario, his investment strategy would unfold like this. At the end of the first year, John's weekly contribution is projected to reach $2,560. After 10 years, the same investment with weekly contributions and dividend reinvestment is projected to grow to $27,832. That's when the DRIP and weekly contribution starts compounding the effect. After 20 years, John's investment is estimated to reach $145,504. Fast forward another 10 years, and in 30 years, John's initial investment has the potential to soar to a valuation of $823,352. Alongside this impressive capital appreciation, he'll also receive $63,395 in dividends every year, translating to approximately $5,283 every month. In total, this portfolio has the potential to add $786,152 to his portfolio investment, with $464,535 attributed to the growth of the portfolio, while $321,617 came from reinvested dividends. And that wraps up our dividend journey. I hope this compilation has equipped you with the knowledge and confidence to turn your investments into a reliable income stream. Remember, your financial freedom is within reach. Keep investing, keep learning, and let your dividends do the rest. Thanks for watching, and see you in the next video.